In this video, I'm going to show you how you can save thousands in tax and pay off your home loan faster by debt recycling. Let's get straight into it. Debt recycling is a strategy where you turn your non-tax deductible debt into tax deductible debt. So you're essentially turning bad debt into good debt. For example, getting a home loan to purchase an investment property is considered good debt since the interest paid on the loan is generally tax deductible. However, getting a home loan to buy a principal place of residence where you live would be considered bad debt because the interest paid on the loan is not tax deductible. Australia has many tax laws that provides incentives for people to invest their money. And according to the ATO website, if you borrow money to buy shares or related investments from which you earn dividends or other accessible income, you can claim a deduction for the interest you pay. Debt recycling allows you to take advantage of this rule. You can use the existing equity you have in your principal place of residence to borrow more money from the bank, then use that money to invest in some income-producing assets such as shares or investment properties. Then you use the dividends or rental income you receive to pay off your original non-tax deductible home loan. This helps you pay off your home loan faster while also allowing you to claim a tax deduction. The end game here is to optimize financial gains while minimizing tax liability. So if you already have a home loan for your principal place of residence, aka a non-investment property, then there are a couple of ways you can debt recycle, which I'll discuss in this video. The most common way is to use the existing equity in your home. Equity is the current market value of your house minus your current home loan balance. For example, let's say your family home is currently worth $500K and you have $300K of home loan outstanding. This means you have $200K worth of equity in your property. To debt recycle, you can use the existing equity in your family home to get a second loan from your bank. The good news is, since you're using your house as a security to the bank, they can offer a better interest rate than if you were to apply for a personal loan with them. Ideally, it's best to get an interest-only line of credit loan so that your repayments are lower and you can concentrate on paying off the non-tax deductible home loan portion even faster. Remember, your new loan is the good debt, so it's better to focus on paying off your bad debt, aka your existing home loan. A line of credit loan gives you a set amount of money that you can use whenever you need it, and you'll only pay interest on the portion you use. So it's kind of like a credit card, a big expensive credit card. So say you refinance to a new $400K home loan, which is 80% of the current market value to avoid lender's mortgage insurance. This will release $100K of equity. Now you may be wondering why we only have $100K of equity. Why is there not $200K of equity like I mentioned before? Well, it's because most lenders will only lend you up to 80% of the property value. Otherwise, you'll have to pay lender's mortgage insurance, which means more fees and defeats the whole purpose of this strategy. So in this case, you'll need to provide a $100K deposit or 20% of the property value to avoid lender's mortgage insurance. Then you are left with $100K of equity. You can then contact your bank and apply for a $100K interest-only line of credit loan. But make sure the loan is split in two. So you have loan 1, which is your original home loan, then you have loan 2, which is your new line of credit loan. You can then use the $100K to invest into income producing assets like shares or property. In this example, let's assume you want to invest in some dividend paying ETFs. You can open up an Australian online brokerage account like Stake and buy some ETF shares that will pay you dividends. And because you've done this, the interest on the new loan is now tax deductible since you are using it to invest in an income producing asset. And since it's an interest only loan, it's easy to track the total tax paid per year during tax time. Once you use the $100K to buy some ETF shares, you can divert all the dividends into the original home loan 1 to help pay it off faster. This is where the debt recycling magic starts to take place. As you are making additional payments into your original home loan from the dividends, you can immediately withdraw the same amount from your line of credit to buy even more ETF shares. So the plan is, as your home loan decreases, your line of credit and shares portfolio will increase. As the dividends go into the home loan, you can keep redrawing the same amount and buy more shares. So eventually, all your non-tax deductible bad debt becomes tax deductible good debt. Let's have a look at how this will work over many years. So in the first year, your home loan will be reduced by the amount of your dividends. Say you have $100K worth of shares paying you 4% dividend. This means you are making $4,000 of extra payments every year into your home loan plus your regular principal repayments. Then you can withdraw the same amount through your line of credit to buy even more dividend shares. Then during tax time, you can claim the deductions on the interest of your new loan, which will effectively reduce your taxable income. The savings in tax will provide even more disposable income for you, which you can add to your investment portfolio and make your snowball larger and larger. In the second year, you should have more shares in your portfolio, therefore you'll be paid more dividends. This means your home loan should be reducing more than last year. Then you keep repeating this for year 3, 4, 5 or as many years as it will take for you to fully pay off the original home loan. So over time, you'll have no more home loan, which was not tax deductible, a large line of credit which is tax deductible, and a huge dividend shares portfolio that continues to produce a large stream of income for you. It's literally a win-win-win. Just make sure you set up the loan accounts properly and don't mix the tax deductible portion with the non-tax deductible portion. This makes it easier on yourself or your tax accountant during tax time. So as you probably figured out by now, the reason it's called debt recycling is that you are paying down your principal place of residence home loan to unlock even more equity. Then you borrow that money again to invest, which is the recycling part. You're taking bad debt and recycling it to produce good debt. So the end goal is you want to turn all your bad debt into good debt. Now you don't have to go with a line of credit loan, you can also use a traditional split loan or investment loan, whatever suits you. All these different loans have different interest rates, so have a chat with your bank about the options you have and go with the one that suits you best. Here is another way to debt recycle. So say you have a home loan and extra money sitting in your offset account that you want to use to invest into shares. Say you had 50k saved up in your offset account that you were planning to buy some dividend shares with. If you went ahead and did this, the 50k won't be tax deductible. However, you can ask your bank to split your current home loan into two loans. Say your current home loan is 500k. Then you can split it to make it 450k for home loan 1 and 50k for home loan 2. So instead of using that 50k to buy dividend shares outright, you could first make a 50k payment into home loan 2, then withdraw the money straight away. Now that 50k is seen as borrowed money since you withdrew from your home loan. You can then go ahead and use the 50k to invest in some dividend ETFs, and that interest on the 50k will be tax deductible. So similar to the first example, you can then choose to direct all dividends to pay off home loan 1 while claiming deductions on the interest for home loan 2. You can then choose to withdraw the extra payments and buy even more shares, which will in turn provide more dividends. So it's like a big circle of compounding interest. Here's another way to look at the benefit of debt recycling. So say you have a 500k loan with a 5% interest rate and 50k cash to invest. Let's look at two options. Option 1, you invest without debt recycling. So you go and open an online broker and you invest 50k into dividend shares and receive 4% dividends per year, which comes to $2,000. So say you're in this tax bracket and you pay 35% tax, so you're left with $1,300. Option 2, you invest with a debt recycling strategy. You split your current home loan and you pay 50k into your second home loan and immediately withdraw the money. You then invest 50k into dividend shares and receive $2,000 income from dividends per year. You still pay the same 35% tax rate, which leaves you with $1,300. However, you can now claim a deduction on the interest rate for your 50k loan at 5%. So that is $2,500. If we use the same tax rate of 35%, it comes to $875. So by debt recycling, you save $875 in tax. And as your portfolio grows larger, the more tax you can save. So the whole point of this strategy is to keep tax deductible good debt and pay off non-tax deductible bad debt. This is a great example of legally using tax rules to your advantage. However, I would strongly recommend seeing a tax professional if you want to try this strategy or any strategies I've mentioned in this video. Please remember, I am not a professional tax accountant, but they are. And they do this for a living, so they'll be able to properly structure your loans and accounts so it's fully compliant with Australian tax laws. So to recap, here are the potential advantages of debt recycling. 1. The tax advantages. From the previous examples, this strategy allows you to turn bad debt into good debt and benefit from the tax rules. And I'm sure you would agree that anything that can legally reduce our tax bill is a wonderful thing. 2. It allows you to pay off your home loan faster. From the first example, you can see by employing a dividend debt recycling strategy, you can shave off many thousands of dollars in years of your home loan. And 3. It helps you to diversify your investment portfolio. In the investing world, it's generally good practice to be diversified. You don't want to put all your eggs in one basket. So with all these advantages, debt recycling is great, right? Everyone should do it. Whoa, not so fast, champ. Please note, I may be oversimplifying a lot of things in my video. Debt recycling has its risk and you need to ensure you understand the risk involved. Number 1, investment risk. There is always risk involved with any type of investment. There is no such thing as a risk-free investment. Your shares may not perform as expected, and instead of helping you save money, it can cost you money. So if you can't handle the volatility, then you need to consider investing into safer and more diversified shares like ETFs. Even these are not 100% safe, but they're generally less volatile. Number 2, interest rate risk. The whole success of debt recycling is hinged on the assumption that the interest rate you borrow will be lower than the expected returns from your investment. So for example, if you borrow at 5%, you want your shares to return more than 5% on average per year. If we go into a long bear market, you may end up temporarily or even permanently paying more money. And number 3, you have cash flow risk. Debt recycling requires you to be organized with your money and have cash on hand to cover all expenses, including loan fees and your regular principal and interest payments. If your investments are not performing well, you may need to make up the difference from your own pocket. So debt recycling is definitely not a sure thing. It's not this magic bullet that solves everything. If you want to debt recycle, then consider looking through this checklist to see if you're the right fit. Firstly, you need a home loan with some equity or extra cash in your offset account. You will need regular income, so make sure you have a job or a business that is bringing in steady income every month. If you have irregular income or work on a casual basis, then it may not be the best strategy for you. You need to be long-term focused. Historically speaking, investments like shares generally become less risky the more time you give it. So you need to be focused on the long term and not just tomorrow. You also need to be comfortable with debt. You need to truly understand what is good and bad debt and be disciplined in your approach. From my own experience, not everyone is comfortable with debt. And if you're one of those people, then maybe think twice before trying this strategy. And finally, you need to have a tolerance for risk and short-term market fluctuations. If you're the type of person who gets nervous and looks at their portfolio 10 times a day, then maybe this isn't for you. You need to be able to hold through both the good and bad times. If you tick all these boxes, then I would encourage you to do more of your own research and perhaps speak to a professional if you decide to go ahead with it. By the way, if you're enjoying this video, comment the word sandwich down below so I know you're one of the legends who made it this far. And if you're new around here, then what are you waiting for, mate? Subscribe to the channel and join the community. There are many more money-saving videos like this to come. So to summarize, debt recycling is not for everyone. You need to be disciplined and understand what you are doing. But if done correctly, it will potentially save thousands of dollars and years of your home loan. And if you want to learn more about how to invest in ETF shares, then check out this video on screen where I'll show you how to easily buy shares in Australia and everything you need to know. As always, thank you for watching, I appreciate you, and I'll see you in the next video.